So far we discussed financial planning for the no change scenario, which assumes that there will be no changes in the company's operations. What if the company plans to have some improvement in its operations? How would this planned improvement affect the company's financing need? For example, if we assume that the company is going to reduce the operating cost to sales ratio to 89.5 from the current 90%, and the company also plans to reduce the inventory to sales ratio to 16% from the current 20%. These changes are reflected in the new set of projected income statement and balance sheet in the next two slides. You will notice that we will still use the same approach as in the no change scenario. The difference now is that we are using a new set of ratios to project income statement and balance sheet items.
When we look at this new income statement, which tries to reflect the proposed improvement, we see that in 2017, operating cost now is assumed to be 89.5% of the sales in 2017, and this number apparently is different from the previous result, which was assumed to be 90% of the sales. So because of this difference or this improvement, net income result now is different, and also the addition to retained earning result is different.
By the way, you may have noticed that in this new income statement, we have a special dividend account. And for 2017, we project to pay a special dividend of $36 million. Because of this, on this income statement, the addition to retained earning is $24 million. And later, when we look at the balance sheet, we'll see that if we don't pay this special dividend of $36 million here on the balance sheet, we will actually see that liability plus equity together will be more than the asset by $36 million.
In the new balance sheet, two items I was noticing. First is the inventories. Now, inventories in 2017 are assumed to be about 16% of the sales. So this number is different now from the previous version of the projected balance sheet. And also, if you look at the retained earnings in 2017 is supposed to be the retained earning in 2016, or say the old retained earning, plus the addition to retained earnings. The old retained earning is the same, but the addition to retained earnings, remember from the last slide, because of the cost reduction, the addition to retained earning result now is different. So now the retained earning balance in 2017 is different. You see now, because of this planned improvement for 2017, these improvements can help the company to lower its financial deficit and lower the need of additional financing, and in this case mainly again due to two things, the reduced inventory balance and also the improved profitability, which leads to the higher amount of retained earnings. So now as you see, the difference between total asset and projected total liability plus equity now is zero, so that means the company doesn't really need to finance from outside, and this is different from in the no change scenario.
Again, remember here we have the retained earning, addition to retained earning of $24 million after paying the special dividend of $36. And if the company doesn't pay the special dividend of $36 million, then $36 more million will be added here. Then the total liability plus equity side will be $36 million more than the sales. So this means this improvement of cost reduction, of reducing inventory balance, actually give us a extra $30 million, which the company can use to pay special dividend back to the investors.
If we follow the same process and use the new set of assumptions, with the improvement incorporated, we can also forecast the accounts, different accounts for 2017 to 2020. We can also use those numbers, balance sheet and income statement figures, to calculate NOPAT, net operating working capital, and also compute for the free cash flow for the next couple of years. We can also calculate the growth in free cash flow as well as the return in invested capital. And if you look at the ROIC, return of the invested capital, you see that this number is actually higher than 8% from the previous result, which was based on the new no change scenario. So again, you can see the improvement here.
So far in our forecast, we calculate the projected amount of all those operating items according to the percentage, or say the ratios, to sales. However, in some situations, it might not be appropriate to model those operating items or operating ratios as a percentage of sales due to the economy of scale, or the non-linearity, or the lumpy asset acquisitions. If you take a look at the two graphs on this slide, can you see the difference between these two graphs in terms of the ratio between asset and sales? Remember, asset over sales, that's what we also call as the capital intensity ratio. In the graph on the left, there is a constant asset over sales ratio, meaning that assets are assumed to always grow with sales proportionally. However, the economy of scale that exists in the graph on the right demonstrates that in some situations, we will have to invest a certain amount before we have any sales. And then the investment per unit would decline as sales increases. So that means we cannot assume a constant asset over sales ratio to project the amount of assets in this situation. There are also situations where the relationship between certain assets, for example inventory, and sales are not linear, as shown on the left. That's just another example that we cannot use the constant percentage of sale ratio to project the amount of assets for the future. Sometimes assets must be added in very large units, often resulting in excess capacity immediately after they are added or say purchased and before sales can grow into them. For example, if we hope to grow our sales by 10% next year, we may need to have a new building to achieve this goal. Problem is that we cannot buy 10% piece of a new building. In this sense, the building itself is a lumpy asset. Once we get a whole new building, and we currently can only utilize 10% of it to generate 10% more sales, the building has temporary excess capacity. So when we have these issues such as economy of scale or the lumpy assets, what do we do with these issues? The forecasted financial statement approach allows us to be flexible and controls the input used in the financial statement. For example, if we believe that the company's long-term assets currently have excess capacity, we can simply just carry over the current level of the fixed asset to the new year in our forecast instead of assuming that the fixed asset has to increase or grow by 10%. Now let's have a summary about this lecture. This lecture is based on Chapter 12 of the Eckert and Brinton textbook. The main purpose in this lecture is to discuss the approaches used to forecast a company's future financial performance, including its need of additional financing and its free cash flow in the next few years. Two approaches are used to project the company's financial need, or say need of external financing. They are the AFM formula and the forecasted financial statement approach. When forecast, we need to be aware of our assumptions. Should we assume no change or planning improvement? Should we assume that interest expense is based on the beginning or end of the year debt balance? In addition, do we have constant asset to sales ratio, or do our assets grow unproportionally? All these issues need to be considered and reflected in our forecast. The following questions provide a guideline for you to analyze the Honeyman case from the BES casebook. You may want to refer to the article The Thoughtful Forecaster from the same casebook as a technical note for its overview of financial ratios and forecasting. Of course, contents in this article are highly consistent with what you have studied in Chapter 2, Chapter 3, and Chapter 12 in the Eckert and Brigham book, or say in Lecture 2 and Lecture 3 that we covered. So the first question is, what is your assessment of the financial performance of this company? Anything that you see really concerns you? Next question. For a profitable company like this, what explains the erosion of the cash balance? Next question. Can you describe Maggie Brown's account payable policy? And do you agree with the policy? Next question. Can you propose some alternatives for solving the company's cash problem? Last question is, what do you expect the financial position of the business to be in 2006? Assume that Bob Brown grows revenue by 30%. Can you forecast a financial statement for 2006 and estimate the amount of free cash flow amount and the company's financing need?
I encourage you to discuss this case with your classmates. Just keep in mind that each group is responsible for writing up your own independent analysis report. For the analysis report, your results and your conclusions should be based on in-depth analysis, and you need to be specific. Do not just say, oh, the company is doing okay, or I think the company has some problems. You need to provide explanations to support your comments or arguments. Your forecast will be based on reasonable assumptions, and you need to list and explain all the assumptions that you use in your analysis. If you can also explain how a different set of assumptions will lead to a different set of results, that would be even better. To help with your analysis, an Excel template for this company's financial statement is posted on D2L. So you just go to the online resource for this week. You should be able to find that file.